Hi, and welcome to the session on freight cost integration with CO, MMSD, and TM, that is Transportation Management. Now, though it is mainly concentrated towards freight cost, but we will also be covering the other additive cost like duty, customs, warehouse management cost, and other overhead that may arise and that is kind of part of the indirect cost of a material. It can be a purchased items, it can be a producible item, finished or semi-finished good, and we are not going to just concentrate on the product costing part of it or the inventory management part of it. We will also be covering the actual postings into different modules, like for inbound freight, how the total freight management takes place without TM module, just using the purchase module, the module. Similarly, for outbound as well, we will see how the freight management takes place with the use of TM or without the use of TM using simple sales and distribution module. And finally, the most important question, which basically triggered me to create this session, and that is what should be the best practice in terms of the treatment of this additive cost like freight, duty, customs, overhead, and everything into the inventory management. Whether they should be part of the inventory or not, whether it should be a blanket kind of a solution for different scenarios for intercompany sales purchase, or it should be based on case to case basis. And also, is it changing for different material types? For procured items, is it a separate practice? For producible item, is it a separate practice? I agree that this is mostly dependent on the business, how they want to treat it. But more often than not, I have seen that business is looking for us to give the best practice from SAP's perspective. So, freight and other additive costs can be broadly divided uh, between procured and produced items because they are treated differently when it comes to this to the type of material or material type. When it comes to the freight cost and its scenarios, how many scenarios can be possible, it can be further subdivided into further categories. Like for example, for raw materials and other purchase items, there can be three scenarios: external vendor purchase, intercompany scenario, and intra-company scenario. Similarly, for produced items, intercompany and intra-company scenarios would be there. Along with that, there would be another scenario, that is outbound freight, that is external customer sales. Okay, so let's first talk about the standard cost, the product costing part of it, and get that out of the way before we jump into the actual part of it. So when it comes to the standard cost, let's first cover the raw material and purchase items. The procured items are generally costed using purchase info record, right? The purchase info record generally includes the base price of the preferred vendor. The reason I said a preferred vendor is because a material can be purchased from different vendors within the same purchase organization. But the preferred vendor is the vendor which charges the less. So in a cost estimate, I can only use a particular vendor for cost estimate. I cannot use multiple vendor for the cost estimate unless we are not using mixing ratio, right? Different procurement alternative, and that is a different story altogether. We are not covering that part here. So for simplicity purpose, I am assuming that I am using the vendor which is the cheapest, and that cost as the standard cost estimate for the raw material or the procured items. Now, in the purchase info record, I can have the base price along with the different additive costs, right? The cost price is basically the base price at which the vendor is basically selling me that item. But along with that, there are some additional costs that I incur to procure that item. It can be the freight or the transportation cost, the cost for custom duty. The cost can be from different overheads like the quality, control cost, the warehouse cost, the handling cost. So these are all the costs that I incur, which may not come from the vendor, but it's the cost that I incur to procure that item. So all these costs must be part of the purchase info record one way or another. Now, what's the process for that? First thing first, we need to make sure that all the raw materials are costed using the purchase info record. That can be done using the valuation strategy in the valuation variant. Now, the strategy sequence under the valuation variant of the costing variant, it is very important. The first priority in the strategy sequence should be the price from purchase info record. That is very important. And when we select the strategy as the purchase info record, it will automatically give you the option of giving some sub strategies. So in this particular example, I have selected quotation price via condition table as the first strategy. So that means that I can maintain whatever conditions in the purchase info record. System will take all those prices from the purchase info record for all the different conditions, and it will club them together and give us the total cost estimate. And also I have the option of segregating different condition values into different line items. Okay, so that's the preferred sub strategy. The second strategy is the effective price, which is basically the summation of the base price or the gross price, or the net price plus the other condition record, which gives me the total effective price. But it's in that process I will lose the track of individual condition types value in the cost estimate. So if I want to know what is my net price, what is my freight, what is my duty, I cannot know that if I use effective price as the first strategy. And the third one is the net price, which is self-evident that it's basically the net price at which I am purchasing from the vendor. It does not include the other additive conditions. Now let's create a purchase info record and see how to maintain the net price as well as different condition types within the purchase info record. Now in the purchase info record, here I want to maintain some price, which is the base price, right, at which I am buying it from the vendor. When I maintain it, it is generally updated against the base price condition type. Okay, and that condition type more often than not is PPR0 or any other PB00, whatever it is. The problem here it is that condition type does not allow any supplementary conditions, which means that I cannot add any additive condition type for freight and duty and so on and so forth. For that, there is some configuration which is needed, though they are related to the purchase or the module, but I would like to show you the process here. First, let's see the configuration behind the base price condition type. Okay, so this is the configuration, and see the base price PPR0. What is the configuration behind it? And the main thing that we are concerned about here is the pricing procedure, which we can see is blank in this particular condition type. Now we will copy it and create another condition type ZPR0, and there we maintain a pricing procedure. Okay, and that pricing procedure is basically the one that will have all the condition types. In a pricing procedure, as we know, we can maintain different condition types starting with the base price and then add all those surcharges and the additive cost. The base price condition type is part of a pricing procedure which includes other condition types as well, so that it allows all those supplementary conditions in the purchasing info record. Now let's see the configuration behind the pricing procedure which was maintained in the condition type ZPR0. As you can see in the pricing procedure, which is created specifically for the additive costing example, in this case, all the pricing conditions are there in the procedure. So when this pricing procedure is assigned into the configuration of the base price condition type, system will allow you to add supplementary condition along with the base price. Now the next step is we have to make sure that while creation of the purchase info record, ZPR0 is picked up as the base price condition, not PPR0. Okay. For that, what we need to do, we have to create a schema group. So here in this example, we have already created the schema group ZA for additive costing. And then in that schema group, we need to assign the corresponding pricing procedure for the purchase organization. So basically, with the schema group, I am doing the mapping of the pricing procedure, and I am making sure that that pricing procedure is relevant for the purchase organization. Once I do that, the next step is very easy. I just need to assign that schema group in the vendor master in the purchase organization, so that when I'll create a purchase info record with that vendor, with that purchase organization, that schema group is referred, which means that the pricing procedure assigned to that schema group is referred, which means that in that pricing procedure I have maintained GPR0 as the base price. As a result, the whole pricing procedure will be there at my disposal when I create the purchase info record. So when I create a purchase info record, you can see the base price is GPR0 now, and also all the different condition types can be added, and these condition types are already there in the pricing procedure. Not only that, I can also have condition record maintained, and system during cost estimate will refer to the condition records as well. The advantage of condition record, as you all know, is that we do not have to maintain the condition values for each material, plant and vendor and purchase or combination, that is in each and every purchasing info record. We can maintain it at a higher level, let's say the purchase organization or a plant, at a material group, at a company, any level, as long as that field which we are referring to, whether it's a company code or purchase or a material group, that is referred, that is called when I'm creating a cost estimate. So material group, okay, it will be referred because it will be referred from the material master. But if I maintain the condition record values at a purchasing group level, then it will not be referred because it cannot be derived from any of the fields that are there in a cost estimate creation transaction. It can be referred in the purchase order creation, because in the purchase order creation I have to mention the purchasing group specifically, but not during the cost estimate. Now that we have made sure that all the supplementary conditions can be added in the purchasing info record or through condition record, we need to make sure that during the cost estimate, different supplementary condition values are shown in different line items, so that we can segregate between the base price and the additive costs. This can be done under the setting of valuation variant. Here we click on delivery cost. It takes us to the mapping of condition type with origin groups. So we can create different origin groups for different additive costs and then map it against the condition type. If we want those origin groups to be featuring separately in the cost component split, the cost component structure, then we can assign those origin groups separately in different cost component split line items as well. Now let's create a cost estimate of a raw material which is having a purchase info record along with different condition types maintained under it for different freights, duty and overheads, and see how it features in the cost estimate. The idea is we need to have them separated in different line items. It should not be clubbed together into as one effective price, and also they should feature into different cost components split under the cost component structure. So as you can see in this particular example, we have different line items for different condition types, and they are segregated by the origin groups, and also we can see different cost components split for raw material, then miscellaneous, then material overhead for different source of condition. In case of a intra-company scenario for procured items, so that means I am purchasing a material, a raw material from an external vendor, and after that I am transferring it into another plant within the same company where it was initially procured. And while transferring it, it involves some cost. It can be freight or any other additive costs. Now, how do we treat that cost? That's the most important question, because based on that decision, we would design the standard cost of the raw material in the receiving plant in an STO scenario. In case of intra-company STO, there is no condition for freight in PO, because if there is no external freight vendor involved, who needs to be invoiced and who will pay that freight? So it is not feasible for one plant to pay another plant within the same company, right? Because that's against an accounting principle. That's the reason there isn't any condition tag in a normal stock transfer PO in standard. Here the material is transferred at the same valuation between sending and receiving plant. However, if there is any outside freight vendor involved who needs to be paid by the company, then it makes sense to add the freight condition in the PO. Or else, if TM module, transportation management module, is used, it takes care of that. In case if the TM module is not used, and in the purchase order we need to have the condition tab so that we can pay the freight vendor through the material management module itself. In that case, we need to create a pricing schema and add it to the PO document type. We will try to cover the transportation management module perspective here in case of intra-company scenario, because that's a bit more nuanced. The cost involved in sending the material generally taken by the receiving plant in case of an intra-company STO scenario. There are different ways to take care of that, either by using additive costing or by using costing sheet. Let's first cover the additive costing part. In order to create the additive costing in case of a intercompany STO scenario, we need to make sure that the plant, the material, and the costing variant is the same for which we are creating the actual cost estimate. So here we'll add different variables. So for adding the freight cost directly, would have to give the per unit contribution of freight and what is the cost element for that. And whatever cost element we put there, system will automatically find out the corresponding cost component from the cost component structure. Like for example, here we have given that for each unit there would be 10 US dollars worth of freight cost involved. So after that we will create a cost estimate with the same costing variant for the same material and plant. As you can see that the additive cost has been added into the cost estimate and it is featuring into a different line. Next up we will see how to cater to the same requirement, that is the cost estimate of a STO scenario for raw materials using costing sheet instead of additive costing. For costing sheet, we know that we have to have three different elements. The first one is the base, the second one is the overhead rate, and the third one is the credit. On a broad level, the overhead rate is applied right on the base. So in our case, in case of intra-company scenario, the base is the procurement cost of the raw material in the sending plant, right? And in the receiving plant, the overhead rate would be applied on top of that as a quantity based or as a percentage based. In case of overhead costing sheet, the major advantage it has over the additive costing is that we can apply a percentage based overhead. In case of additive costing, I have to mention for each unit how much is the additive cost. But in case of costing sheet, I can maintain a percentage based. So that means whatever is the procurement cost in the sending plant, on top of that I can maintain a 10% or 20% rate as the freight, which would be applied as a cost estimate in the receiving plant. And that is a very important functionality of costing sheet, because that is how it is treated in case of intercompany or intercompany scenario in actual, in real life as well. In the purchase order, when we create the STO, actually the freight rate is applied more often than not as a percentage based on top of the sending plant's cost. Now let's create a cost estimate with the overhead costing sheet that we just maintained and see the result. As we can see in the cost estimate, the freight item is coming as a overhead item category in a separate line in the cost estimate. But this whole process is not a standard process. With the cost estimate of a material for which a stock transfer from one plant to another has been entered as special procurement, the system does not calculate any overhead rates. There is a SAP Node, that is 679587, which elaborates this process in detail. So in that note, there is a mention of a body called sir underscore stock underscore transfer underscore CK. That body needs to be implemented. Okay, and in that implementation of the body, we need to hard code the costing sheet for which the surcharge need to be activated. Okay, so in the code inside that body, we need to basically activate the surcharge so that the costing sheet is active, and whatever rate mentioned in that costing sheet, overhead rate, is applied in case of a material having special procurement key of stock transfer. Now this process takes care of the standard cost either through costing sheet or additive costing. What about actual cost? In STO process, cost does not get posted to the material. It is posted to the cost center. In transportation management module, using freight cost distribution, we can allocate the cost to the material from cost center to the material. But is it recommended? Is it the best practice? Because remember, that is the premise from which we have started this whole session. In case of intra-company process, the same material cost would go artificially inflated every time it's transferred from one plant to another. It's not accepted in many companies. So the freight cost is captured in purchase cost center and assessed to the production cost center through assessment cycle. And from there, it becomes part of the cost of good manufactured of the produced item. So again, the freight cost of procured items will eventually go to the produced items as indirect cost. If freight is not considered in actual, then it should not be part of the standard as well for raw material. It should be part of the standard for produced items. So to summarize, the recommended approach is that freight should be part of the produced items COGM as indirect cost. It should not be part of the standard cost estimate of the raw material. Now let's discuss about the intercompany STO process. In case of intercompany stock transfer process, it depends who will organize the freight. Generally, the freight is organized by the sending company. They organize and pay the freight vendor for the transportation. Then they bill the receiving company for that freight separately. So it basically impacts both the cost of sales of the sending company and inventory of the receiving company. Sometimes the receiver organizes and pays for the transportation directly. In that case, it will only impact the receiving side. In case of standard cost, the freight cost needs to be added in the receiving plant either using the additive cost or costing sheet. If the planned freight is added as a percentage of the sending plant's cost, then it's better to use costing sheet, because there we can use the manufacturing cost as the base in costing sheet. But again, this is not standard. As we have already discussed, we need to implement a body to activate that functionality. But if the planned freight amount is per unit or weight base, then additive cost is preferred. Now let's discuss about the produced items, that is semi-finished and finished goods. Let's start with the intra-company scenario. The cost involved in sending the material generally taken by receiving plant in case of an intra-company scenario. Okay. So it can be done either by using additive cost or by using costing sheet. It's the same as the raw material process. So we are going to skip to the next process, that is the intercompany scenario for produced items. And the intercompany process is also the same as the purchased items as far as the standard cost is concerned. But for actual, it is completely different, and we will discuss it later. For sales to customer, the transportation can be organized by the customer or the sending plant itself. If the freight is organized by the customer, then there would be no entry. Also, it won't have any effect in material valuation or cost. If the freight is organized by the company, that is the sending company, it will then subsequently invoice the customer for the same. So there would be two entries. First, the cost of freight when the freight vendor is paid by the company, and then freight revenue or negative cost of freight depending on the business preference in the company during the customer invoice. So again, cost of freight during the freight vendor payment and freight revenue or negative cost of freight during the customer invoice. In either case, the freight is borne by the customer, okay, not the sending company. The material cost estimate or inventory does not include the freight portion, hence no change in the standard cost estimate process. Now let's see the actual process, especially focusing on the freight part. Let's start with the external vendor purchase. In case of external vendor purchase, there are two different scenarios. One with the use of transportation management module, and the other one is without the use of that. So here we are not using the TM module, and all the freight conditions, the additive cost, the customs duty and overhead will be part of the conditions in the purchase order itself, so that when I am doing the good receipt against the purchase order, all the conditions will impact my good receipt value or my inventory value. So let's go into the good receipt material document and the corresponding accounting document. Here we can see that there are three major entries. The first one is the inventory of the material. It can be a semi-finished or a finished material or a raw material. It can be any kind of material. We are considering the external vendor purchase, and it can be for any component, but generally it is for a raw material. So the inventory would be updated as per the standard cost or the moving average cost of the material. Okay, so in this particular example, it is a standard cost item because material ledger is active, actual costing is also active, so it's a standard cost item. So that's why the inventory is updated as per the standard cost. Then we have the GRIR, and that GRIR value is as per the base price. And then we have different additive costs for overhead, freight and everything. So the difference between inventory, GRIR and the additive cost, which includes freight, will go into the price difference account, because this is standard price maintained. If it were moving average price maintained, then it will directly update the inventory account, but here it will update the price difference account, which will be updating the periodic unit price during the material ledger closing, which in effect will update the ending inventory of the material. Now let's see a purchase process for the similar kind of a material but with transportation management module active. So in that case, the purchase order will not have any freight related conditions in the purchase order. It can have some other additive costs like customs duty, which are not affected by the transportation management module, but any freight related conditions will be absent in the purchase order. Now let's do the good receipt against that purchase order and see the corresponding accounting entry. So as there is no additive cost condition in the purchase order, you can see the only major element there is the GRIR, the inventory, and the price difference account. Okay. So the freight amount will come from the transportation model. Let's first understand what is the process for TM accounting integration. The first step in TM is the freight settlement process, where the total cost of freight is charged to a freight clearing account, and that freight clearing account is basically a P&L account which has default account assignment of a purchase cost center. And the second process is the agency business document posting for the distributed cost, where the total cost of freight is distributed between the materials which were there in the consignment or in the purchase order or in the truck. Okay, and that distribution happened based on the quantity or volume. So here in this particular example, the first document, that is the freight settlement document, that is generated against the service purchase order, which is generated against the actual PO. And when the service purchase order is processed, the service through service entry sheet, it goes to the freight clearing account, and from there it is distributed to the material inventory. So in case of moving average price, it directly updates the material inventory. In case of standard price, it will update the price difference account. Let's first see the transportation management freight settlement document and the corresponding accounting document. The accounting document, as I said before, would be generated against the purchase order, the service PO, which is created against the main original PO. And when the service PO for freight is confirmed, then the accounting document is generated where we have the freight clearing account getting affected. This amount is currently at the cost center level, and in the next step of TM, the cost will be distributed among the materials in the consignment of the purchase order. So let's do the freight distribution process. So here I will take the settlement document and I will release it to counting, and system will automatically distribute it among the material. And when I will analyze the accounting document for the freight distribution process, I'll see the material number getting populated here. So you can see all the materials which were there in the consignment or in the PO are getting populated, and this material being the standard price control maintained, it will go to the price difference, which will finally go to the inventory when I do the material ledger closing. Now let's discuss about the actual process of intra-company stock transfer. As we have already covered, in case of intra-company STO, there is no condition for freight in the purchase order itself, because if there is no external freight vendor involved, there is no payer or there is no payee. Okay, so it's not feasible for one plant to pay another plant within the accounting, within the same company, as it is against the accounting principle. So in case there is any transportation involved, the STO document type related configuration to be modified to add a pricing schema, or else use TM module. The postings are exactly the same as the inbound purchase process. So I'm not going to show you the intra-company STO's corresponding freight process, because it's exactly the same as the inbound purchase process. For the receiver, there is no postings in the sending side, but in the receiver side, it's the same as the inbound purchase process from TM perspective. The only difference is that the cost is not transferred to the material using freight settlement if I am purchasing or I am transferring a raw material. So the cost remain in the freight clearing account, which has an account assignment object as a cost center, and that purchase cost center contains all the cost, and during month end processing the cost is assessed from the cost center to the production cost center, through which it becomes the cost of the semi-finish and the finished goods indirect cost. But in case of semi-finish or finished good transfer through intra-company STO process, it's the same as the inbound purchase process, where I take the cost initially at the purchase cost center, and from there I transfer it to the material account using freight cost distribution process that I just demonstrated. Now let's discuss about the external customer sales actual processing. For sales to customer, the transportation can be organized by the customer or the sending plant itself. In either case, the freight is borne by the customer. So the material cost estimate or inventory does not include the freight portion. If transportation is organized and paid by the customer, then there is no activity needed. But if it is organized by the sending company, then the corresponding expense and payment to the freight vendor need to happen in the system. So like the inbound purchase process, for outbound freight also there would be a freight settlement document against the outbound delivery, and in that freight settlement document it will hit the freight clearing account and the GRR clearing account. The freight clearing account in this case will be associated with the account assignment object of profitability segment if COPA is activated. Otherwise, it will still be hitting the cost center. The second posting is the freight cost distribution to the material. And here the freight clearing account will be credited and it will go to the outbound freight expense account. And this expense will go directly to COPA or profitability analysis, as this is happening after the production and during the sales. So it is part of the cost of goods sold. So that's why it is going directly to COPA. The next process is the customer billing process. And here you can see the total freight is getting charged back to the customer. So the freight expense is getting reversed, or you can say the freight revenue is getting credited and customer receivable is getting debited. So let's see in the system now. This is an outgoing customer sales order, and this is the corresponding freight settlement document created against the sales order, and you can see the link of the sales order in the freight settlement document in the TM. Now the service PO created against the TM freight settlement document for processing of the freight and finally the payment of the freight vendor is this one, and as we can see the service PO has the service entry sheet and the corresponding incoming invoice. In the service entry sheet, the entries are as mentioned before. It goes to the cost of freight account, which goes into the cost center or profitability segment. Now let's do the freight cost distribution process so that the total cost of freight goes into the material level. As we have discussed before, unlike inbound purchase, it will not go into the inventory, rather it will go into the profitability segment or COPA for individual materials in the consignment. When the freight is distributed to the material, it goes to the COPA with material as one of the characteristics of the profitability segment. As you can see, sales order on the line item is also one of the characteristics in the COPA. When the customer is billed with the freight amount, as the customer need to pay for it eventually, it goes as freight revenue. And this entry happens during the customer invoice. And last but not the least, let's discuss about the actual processing for intercompany STO process for freight. In case of intercompany process, Generally, the transportation is organized either by the sending or the receiving company based on the logistics preference. If the receiving company arranges and pays for the transportation, it means it will be the same as the external vendor purchase process, where there is no involvement from the sending side. It means on the sender side there will be no entry, but on the receiver side the cost will entirely be on the inventory side. Now, if the sending company arranges for the freight and pays for the transportation, then they will invoice the receiving company for the freight amount so that the receiving company will eventually pay for it. To cover the entire spectrum, in this particular example, I have considered that it will be a two-step process. That means that initially the freight would be organized by the sending company and they will pay the freight vendor for the freight cost, and then they will charge the receiving company for the same through intercompany invoice, and it will then eventually affect the receiving company's inventory. So it means when the sending company arranges and pays for the vendor, it is same as the outbound freight process. So initially it will affect the freight clearing account, and then it will get distributed at the material level in the profitability segment, and it will hit the outbound freight expense. Then for the same amount, the sending company will bill the receiving company through intercompany billing, and then it will affect the freight revenue for those materials. And in the receiving side, it will then go as a price difference account in the receiving company, or else it will go as in the inventory if it is moving average price. So this is an intercompany stock transfer order which was created between two companies, and it has the sending plant manufacturing cost as the base price, on top of which we have different additive cost. But remember, as we are doing it through the transportation management module, there would be no freight related condition type. Okay, so here for the sake of time, we are skipping the first two steps, that is 2A and 2B, that is in the sending side. We are directly going to the 2C step, that is the intercompany billing step. By that time, the sender has organized the freight and it has done the payment to the freight vendor, and this would be the process similar to the outbound freight process. So it has gone into the freight clearing account. From there it has gone into the material level into the COPA as cost of freight, and then it is charging back to the receiving company through intercompany billing process, and we are taking it from there. So as we can see in the intercompany billing document, there is a freight condition type, and this one is derived from the transportation management document which was created by the sending company. So let's see the accounting document now. So as you can see, there is a line item for freight revenue or a negative cost of sales. It depends on the business how they want to call it, and it is affecting the total account receivable, and then the corresponding incoming invoice which is generated out of this intercompany billing document. Let's analyze that as well. So the incoming invoice created against the intercompany billing has the same freight amount, and it's going to the price difference account. This amount will go to the material inventory and periodic inventories after month end during ML closing. So that concludes the session, and hope it adds some value to your knowledge if you are a logistics consultant, or even if you are a finance or controlling consultant. So I would expect that next time when you go for an implementation project and the client asks you for the best practice for the treatment of freight, then I guess you have better answer to that. Thank you and take care.